Hello and welcome to Morningstar. I'm Emma Wall and I'm joined today by Mike Scott, manager of the Schroder Monthly High Income Fund. Hi, Mike.
Hi, Emma.
So we're here today to give three stock picks, or three bond picks, I should say. What's the first bond today?
The first would be the lower tier 2 bond issued by BAWAG Bank, which is an Austrian regional bank. In our opinion, we think that the background or the trends within the financial sector are positive. We think that the regulator is forcing banks to raise an ever-increasing amount of equity to be held against the loans or within the balance sheet. And this is only a positive thing from a creditor's point of view. In particular, with this bank, it's restructured quite heavily over the last 3 to 5 years. It's got out of the riskier end of lending. It's now predominantly involved in consumer and retail loans. And it's actually one of the few banks that is delivering double-digit return on equity within the European financial space. In our view, the private equity owner, because it is still quite a small bank relative to the larger players within the space, are likely to want to exit their investment, and this will either come through an IPO or a sale. Usually, in an IPO, that requires further equity injection into the bank, which again is positive from a creditor's point of view, and secondly, a sale to a trade buyer would also increase the credit quality of the bank, given that it will be taken out by a much better capitalised or larger player.
You have described it as quite low risk there, but I think a lot of people will see European bank and think that's risky. So is the yield that they're offering reflective of the risk in that market?
Well, we think so. I mean, they trade with a spread of 380 over. Now, these are BA1 positive outlook bonds. We think that on a standalone basis, these are investment grade bonds. So investment grade bonds typically trade, say, 200 to 250 over. So there's, at least 100.
Good premium.
There's a decent premium already baked into the price. And nonetheless, we think on a standalone basis that the credit quality is investment grade. In the event that there's an IPO or a takeover of the bank, then clearly it would be investment grade too. So we think that whilst the riskiness, I guess, of the bond is or the credit is there, we think that that's very much in the price.
And what's the second bond today? The
second bond today would be Iceland.
The frozen food retailer?
The frozen food retailer, indeed. Now, the high street or the sort of food retail market has undergone quite substantial change over the last 2 to 3 years, in particular by the emergence of the discount chains out in Lidl. And this has really been putting pressure on the top lines of high street food retailers. I think to
the detriment of Tesco and indeed Sainsbury's and
exactly. But I think we're quite far through this process now in terms of the price deflation. But nonetheless, Iceland in itself, actually, we think holds a very important niche within the food retailing business. It's high street orientated, it's frozen food orientated, where it is the second largest player. We think that management is doing the right things with respect to investing its offer. It's slightly changing the proposition, as you say, through
advertising.
Through the advertising.
Do your whole Christmas frozen.
That's exactly right. So Peter Andre is leading that. Whether or not that will be successful, time will tell. But nonetheless, management are doing the right thing. They're investing in the offer. It's one of the few food retailing companies actually free cash flow positive. Now, the leverage through the bonds is 5.5 times. Recently, a new investor came into the group, valuing the company at over 8 times EV to EBITDA. Therefore, there's a significant equity cushion within the structure beneath the bonds. And therefore, we think that buying these bonds at the cash price of 88 to 90, a substantial discount to par, we think that this is more, the risks are more than priced into these to these instruments. In fact, we could see these bonds trading up to sort of 94 type level, which would deliver a 12% IRR for next year.
And what's the third and final bond? The
third and final bond would be Erste Tier 1. Now, Tier 1 paper, these are old style, pre-Basel III capital, which will actually be redundant within the bank capital stack going forward, as we're seeing more issuance of CoCo and alternative Tier 1 instruments. Now, these bonds will be taken out at the first call, in our opinion, and the first call date is next year. In the meantime, they're paying an 8.5% coupon, an 8.5% yield to that call.
Which is very attractive.
Which is very attractive relative to the likely volatility. In our opinion, these will deliver probably the strongest return to volatility characteristics of any bonds within the portfolio.
Mike, thank you very much.
Not at all.
This is Emma Wall from Morningstar. Thank you for watching.